Within a single year, Amazon eliminated 30,000 corporate roles. Oracle cut half its workforce in India. Microsoft followed with 15,000 job losses. These cuts aren't targeting low-level staff. They are striking mid-level software engineers, HR directors, and customer support leads. Corporate leaders claim these roles are now functionally replaceable by artificial intelligence. The official narrative for these firings is consistent across the sector. Executives say they must clear their payrolls to free up the immense capital required to restructure their companies around AI. Consider the scale of the trade-off. Laying off 30,000 workers might save a company a few $billions in annual salary. But in that same window, the industry is spending over $300 billion on AI initiatives. If the money saved from these layoffs barely covers a fraction of the cost of the technology, the rationale behind these massive headcount reductions remains a critical, unanswered question. The tech industry is shifting its entire existence away from the high-margin software-driven model that defined the last 20 years. It is reorganizing itself into a resource-intensive, hardware-heavy extraction business. Traditional data centers were designed to run human-coded software. Their power requirements are relatively modest, pulling roughly 10 kilowatts per server rack. The new Nvidia AI GPUs operate on a different scale of physics, pulling up to 132 kilowatts per rack. This intense power draw generates so much thermal energy that standard air cooling is no longer physically possible. To prevent the hardware from melting during parallel processing, these facilities require complex direct-to-chip liquid cooling systems, an architectural requirement that traditional data centers were never built to handle. These new AI factories have a massive physical footprint. They span thousands of acres of land and consume as much electricity as 1 million individual households. Feeding that demand has forced utility companies to reverse their green energy promises, unretiring old coal-fired power plants, or dedicating entire nuclear reactors to power single data centers. Building this infrastructure is so prohibitively expensive that tech giants are liquidating their human workforces just to keep pace with the physical requirements of the hardware race. Big tech is currently on a $650 billion spending spree, aimed almost entirely at outfitting these specialized data centers. But the capital isn't leaving the industry, it's moving in a closed circle. Companies like Apple rent infrastructure from Google, who in turn takes that money and buys chips from Nvidia. Nvidia then passes that capital to foundries like TSMC for manufacturing, and companies like ASML for the specialized machines required to build the silicon. The web gets tighter as the scale grows. Amazon buys from Nvidia. Microsoft buys from Amazon. Meta rents capacity from almost everyone. The same dollars are endlessly looping between a handful of players. This localized spending surge is so massive that these 7 companies now represent 37% of the entire S&P 500 index. This boom is an illusion of growth. These companies aren't yet generating significant profit from outside consumers. They are inflating their own valuations by passing the same capital back and forth within their own ecosystem. The critical flaw in this ecosystem is the lack of return. Despite the hundreds of billions spent, almost no one is earning a net profit from selling AI services to the public. Investors are currently paying $35 for every $1 of actual profit these companies earn, betting entirely on the promise that AI will eventually dominate the economy. This has created a trillion-dollar game of chicken. No single CEO can afford to reduce their AI spending without signaling to the market that they have lost the arms race. If any major players stops buying hardware, their stock price would instantly collapse as investors assume they've been left behind, locking them into a cycle of mandatory escalating costs. While the market waits for a return on its investment, the physical world pays the price. Massive concrete footprints are replacing the natural landscape as companies rush to build capacity they may never fully use. This standoff has created a resource-draining echo chamber that must eventually answer to reality. If the financial bubble pops before the technology can sustain itself, the entire economic system collapses along with it.